Barfresh Food Group, ticker BRFH, just reported Q2 2026 earnings, and they missed consensus across the board.
Yeah, badly. I mean, it was a rough quarter,
Right, so revenue came in at $4.71 million, which missed the $5.35 million target, and EPS was negative 12 cents.
which, missed the negative 5-cent consensus by a pretty wide margin.
Exactly, and guidance. Full year 2026 was completely slashed. Like, revenue is now projected between $23 and $26 million.
Right, with the adjusted EBITDA loss getting worse, too, falling to somewhere between $1 and $2 million.
And the market reaction was brutal. I mean, the stock plunged 30.7% post-earnings, settling right around $1.30.
It's basically a bloodbath.
It really is. And if you're looking at these numbers at home, you're probably asking yourself, wait, revenue is actually up 190% year over year?
Right. Like, how does that lead to a 30% stock crash?
Exactly. So let's look at the quality of that revenue, because almost all of that top-line surge came from acquiring ARPSterity.
Yeah, ARPS contributed $3.2 million. But the catch is, well, the vast majority of that is just raw and processed milk.
Which is, super commoditized.
Right, very low margin. Meanwhile, the core business, like the higher margin frozen beverages and smoothies, that only grew 9%.
Wow. So this low-margin milk suddenly makes up the bulk of their sales.
Yeah, and combined with massive integration costs, their gross margins just completely collapsed. I mean, last year, they had a 31.1% profit margin.
In this quarter.
Negative 3.2%.
Hmm.
They are literally losing money on every single dollar of sales right now.
Man, that's rough. Because ARPSterity was supposed to be their salvation, right? Like a way to secure their own supply chain.
Exactly, but management admitted the aging infrastructure there just couldn't handle the volume.
Yeah, they literally had to temporarily halt ice cream production entirely just to fulfill their core smoothie orders.
Right, it's a huge operational bottleneck.
It's like buying a fixer-upper house without getting an inspection. You think you're getting a great deal, but then you realize the plumbing is completely shot.
Yeah, and you can't even use the kitchen.
Exactly. So my question is this just a temporary renovation cost, or are we looking at a structural money pit?
Well, management is definitely framing it as a transition phase. Their strategy to survive this bottleneck is winning back the education channel.
Right, and they did just secure 50 new school districts in Ohio.
Which sounds great, but if you dig into the 10Q filing, it is flashing red. They only have $324,000 in pure cash left.
Wait, only $324K? That's nothing for a public company.
Nothing. And that low balance triggered an official going concern warning from the auditors.
Oh, wow.
Yeah, meaning they highly doubt the company has enough capital to survive the next 12 months. Plus, they disclosed a material weakness in internal controls.
So their financial reporting isn't even reliable right now.
Right, and they got a NASDAQ listing deficiency notice on top of all that.
So they're basically on financial life support. I saw they're relying really heavily on a recent $7.5 million convertible note.
But here's the kicker. They aren't using that to fuel growth. They used it to pay off an old mortgage.
Yikes. So using a convertible note just to keep the lights on is basically like taking out a high-interest payday loan just to pay your standard mortgage.
It's highly desperate. And their other lifeline is a $2.4 million USDA equipment grant. But the timeline is terrifying.
Because it expires by the end of the year, right?
Yes. To actually use those funds, they urgently need to get their brand new 44,000 square foot facility in Defiance, Ohio, partially commissioned by December 31st.
And if they miss that deadline?
They lose the grant money entirely. And they stay trapped in that broken down ARPS facility bottleneck.
So this entire company's survival hinges on execution in the next few months.
Which brings up the ultimate risk-reward scenario you really have to consider here. If Barfresh can survive this severe cash crunch and commission that Defiance plant by year-end, they finally control their own captive supply chain.
No more third-party co-packers.
Right, they'd bypass them completely and directly supply those thousands of schools. But if the infrastructure delays continue, it's not even about margins anymore.
It becomes a solvency issue.
Exactly. The real question is, will they run out of financial runway before those smoothies ever actually reach the cafeteria?
A ticking clock and a shrinking bank account. Make sure you follow the show for our daily retail investor earnings coverage so you never miss a deep dive into the numbers that matter.